We're already the most popular and influential podcast slash video streamer, not really streamer, but it feels like a streamer when I'm recording it, in the entire world. So, there's not really much improvement that we can have going on here, but hey, we'll still take feedback from you. You might be saying to yourself, David, who the fuck told you that you're the most popular podcast in the entire world? Well, my sources, I fucking made it up. But, we're going to pretend like it is until it actually comes true. What's up, apes? Welcome back to another edition of the Daily Peels Daily Podcast of the Day. Thank you all so much for joining us here once again on this beautiful Thursday, September 12th, 2024. It is currently 6:59 p.m., about to turn 7 o'clock, aka my bedtime over here in the eastern coast of the United States. You might be saying to yourself, if you're watching this on video, David, what's going on over there? Did you get a new makeup routine? Did you get a new haircut? Did your mustache double in size? What's going on? Because something seems a little bit different. Well, unfortunately, it's none of those things, although those would probably all help me out greatly. But instead, what we're talking about here today is the new setup that we have going on at the Daily Peel Global Headquarters, the brand new offices of the Daily Peel Global Headquarters that we just moved into. Trying out something a little bit new here today. So let us know if you guys like it, if you hate it, compared to our usual style of me with my phone and the green screen behind me, and then we just kind of make shit up as we go, versus what is about to happen that you're about to see unfold. We're already the most popular and influential podcast slash video streamer, not really streamer, but it feels like a streamer when I'm recording it, in the entire world. So, there's not really much improvement that we can have going on here, but hey, we'll still take feedback from you. You might be saying to yourself, David, who the fuck told you that you're the most popular podcast in the entire world? Well, my sources, I fucking made it up. But, we're going to pretend like it is until it actually comes true, because like we talked about in a recent piece, economics, and specifically inflation, is one of the few areas in the world where actual manifestation actually works. So if you're into that bullshit, get into economics, because it's the only place that it's actually going to matter. Speaking of economics, let's go ahead and dive into today's Daily Peel. There was a lot of movement going on in markets here today, digesting some additional inflationary movement that we got going on. Now, the S&P 500 finished the session up about 75 basis points, rising intraday after a scary opening, once again in reaction to the inflation report. NASDAQ was up a full percentage point, 100 basis points even. WSO Alpha portfolio outperformed the S&P 500, which really isn't even an accomplishment because of how fucking easy it is to do. We do it just about every single day. I don't know what's wrong with these active managers and why they can't keep up with us, but nonetheless, that's the situation that we're in right now. WSO Alpha portfolio up 86 basis points for the session, back to about 9.45% total return for the year. Actually, that's not total return. That's only price movement, dividends, and shit like that would probably bump it up to maybe 10% or so. Still drastically underperforming the S&P and the NASDAQ. I promise you guys, if you look at any 9-month period besides 2024 so far, we tend to outperform quite a bit, but it's been a rough year for us, very choppy waters in that regard. We're a very risk-on portfolio too, so, you got to expect these fluctuations, but if you're in it for the risk, then come join us, go subscribe to WSO Alpha. All right, like I said, we got a lot to talk about here today, including a brand new inflation report. We're talking about wholesale inflation today, which came in about as boringly as you would expect it to. It doesn't really change too much for the inflationary picture, but certainly could for the Federal Reserve going forward with that huge interest rate decision coming early next week or about midway through next week. We're then going to be going into some of our biggest stock movers of the day. Now, we did get some pretty wild movements from companies like Kroger, aka the guy who, according to Kamala Harris, has been price gouging Americans far and wide from sea to shining sea. We'll talk about why that is absolute dog shit and completely fabricated. We're also going to be talking about Roku. They got a big upgrade, some new fans going on over there. Moderna's complete collapse on the day they really tried to do something. It did not work out well whatsoever. And finally, Wells Fargo is going to prove once again why they are the bad boy of banking. And then certified smarty pants Torsten Slok. I'm thinking about hiring him as my personal assistant going forward. I'm sure he would jump at the opportunity, given that he is the chief economist of Apollo, not really doing anything over there. So he can come join the world's most popular and influential newsletter as well. We're going to be talking about the housing market outlook, or really, as I should probably say, the housing market lookout. So let's go ahead and get into some of these banana bits before we get into all that fun stuff. First and foremost, the Fed is facing a big decision going into next week. So we pretty much have all of the economic data that the Federal Reserve is going to give two shits about going into this report. Now, I say that because we just got the inflation reports earlier this week. Now, the Fed doesn't really give a damn about CPI or PPE. They are much more focused on PCE, and specifically core PCE, and specifically core PCE on a quarterly basis, because it tends to smooth out some of those wild fluctuations that you get from things like food and energy prices, because who the fuck buys food and energy, So none of that really matters at all. Their decision right now is, do they start with a big rate cut, go 50 basis points right from the top, or do they kind of inch into it a little bit? Personally, I think the answer is easy. Jake Mao is a man of conviction. Don't be surprised if he comes out there and dazzles markets with a 50 basis point cut in September. If he doesn't, probably going to do it in November unless we get a huge change up in the economic data that comes out between now and then, specifically the second and third estimates of GDP in the second quarter. We're going to get 2 jobs reports, 2 more CPIs and inflation reports, retail spending, consumer checkpoints, all this different fun stuff that we'll be going over the next couple of months. Speaking of the consumer checkpoint, Bank of America did just drop that on Tuesday of this week. Go check that out because it's given us some hope in consumers. Looks like spending on their card data grew by about 0.9% in the month of August after declining in July, so that gave us some hope once again. Meanwhile, this might be the biggest story that we've ever talked about here at the Daily Peel. Now, a lot of you are familiar, probably most of you are familiar with the absolutely ridiculous, egregious, inexcusable work hours that these banks make, junior analysts and bankers go through when they first start. Oftentimes, we're hearing stories of 100, 110, even 120-hour work weeks. Now, earlier this year, if you recall, there was a tragic story of a veteran of our military services who was an associate at Bank of America who unfortunately very tragically passed away because he was working his absolute ass off at Bank of America. Now, this is a guy who is known for hard work his entire life. He was a damn Green Beret, one of the most impressive people in the entire country, if you ask me. Went and worked for Bank of America and ultimately suffered from not a heart attack, but there were some cardiovascular issues that ultimately led to his demise that were related to the long working hours. Well, it seems like they heard the message, and I think you guys and the team here at Wall Street Oasis, not me, but pretty much everybody else, did a great job of spreading the word and making sure that we were able to not let this go under the rug. So JP Morgan and Bank of America were the first 2 bulge bracket banks to do this, but they have officially come out and committed to 80-hour work week maximums for junior bankers and junior analysts. They did say that there's new time tracking systems that they'll be using so that they actually hold themselves accountable, but with the trajectory, this isn't the first time in the industry that this has happened. And given the past trajectory where, a little bit pessimistic or a little bit skeptical going into it, but certainly hoping for the best. Again, rest in peace to 𝗟𝗚𝗚𝗛. Go check out that fundraiser for his family. I can't imagine a more deserving cause. Okay, moving on down below. We got a federal judge who just came in and reported, or actually basically he didn't really make a decision, but he's kind of giving early indications that federal courts are going to permit betting on the federal election here in the United States. It had been a little bit of a gray area beforehand, event-driven, what are they called? I'm totally blanking on the name to describe like Polymarket and Kalshi and all those other ones that they have, but Polymarket has kind of been doing this for a while. They don't really give a shit about the United States. You need a VPN to use it here anyway. Don't ask me how I learned that. But Kalshi, you can now bet on the U.S. presidential election there. So if you're looking to make some money on that stuff, go ahead and check it out. Or I guess if you're going to bet on Trump winning, you might as well buy DJT because the returns are probably going to be a lot bigger given how small that float is. Okay, Adobe shares completely plummeted after hours on a dog shit earnings report that really wasn't that bad, but investors clearly thought it was. Now, when I was looking at it earlier, it was down about 9% or so after hours, but let's go ahead and take a look here. Okay, so it's still roughly what I was looking at. It's down 8.91% in the after-hours session so far. Had been down as much as 10.20% in the after-hours session. Again, pretty dumpy earnings. We'll be talking about it all tomorrow. Finally, Japan. This is the country of the rising sun. Well, they are becoming a rising sun in their own right in the private equity world. We had JP Morgan, private equity associates on the JP Morgan side. Well, not associates, but private equity directors or whatever the fuck they're called on the JP Morgan side coming out and saying how important the Japanese market is becoming within the scope of APAC and really the globe in its entirety. So the burgeoning empire in the world of private equity. Make sure to take our Daily Peel daily poll of the day as well if you get a chance. And let's go ahead and get into our big macro monkey story of the day. We are, of course, talking about we're going to need a bigger cut. Anybody who's seen Jaws should immediately get that brilliant reference right there. So that's basically the situation that the Federal Reserve is in right now. Okay, and so what I'm going to do here is kind of try to pull up some charts on my Excel sheet here as well. Not Excel sheet, my PowerPoint sheet. Let me see if I can share my screen. Hopefully that looks good. I mean, I know it looks better because my face is taking up less of the screen, so that automatically means that it must look better. You guys weren't supposed to see this chart just yet. Okay, there we go. Now we have it set up how it should be. So this is going to be interesting. This is the part that I want you guys to tell me if you like it, if you hate it, what you think about it, if we should go back to our old style. But we got the PPI report here today, and we have to talk about it. Now, in the movie Jaws, Police Chief Martin Brody, he was smart enough to realize when he saw that fucking monster in the ocean that, A, we're going to need a bigger boat or we're going to end up like the goddamn Titanic, eaten alive, and probably even worse than that. Federal Reserve Chair Jerome Powell is in a very similar position. He saw this giant shark in the form of a 0.1% rise in the unemployment rate in the month of August. So obviously that made everybody shit their pants and kind of worry about what's going to happen going forward with rate cuts in the economy more holistically. So the position that he's in kind of right now is kind of similar to what we described earlier with the first banana of its piece. Do you start hot? Do you go big at first and start with, start with those big cuts right from the get-go? Or do you just start with those smaller cuts and then gradually ease into these larger ones? That is essentially the decision that the Federal Reserve is facing right now. And let's talk about exactly why. So since the annual inflation rate started to decline with Jay Powell's rate hike nuclear bombing campaign that he was on, it's become clear in the recent months especially that inflation is well on its way to that 2% target. We got CPI print of about 2.5%. We saw quarterly PCEs in the low twos, like 2.1, 2.2%. So if you ask me, we are back at 2% inflation. It's just shelter that is keeping the data from suggesting that. But in actuality, we are back at 2% or potentially even below. So given that inflation is on the decline and inflation and unemployment have an inverse relationship, so inflation goes down, unemployment tends to rise higher by variable degrees, that makes a recession risk much more of a macro focus than inflation has been, or at least in the past couple of weeks. Like where we were worried about inflation, we're now worried about unemployment and the loss of jobs leading to a recession via declining consumer spending and general wage growth. So what this report did today was essentially confirm that, yes, inflation is still on its way out and that unemployment is a risk of leading us into a recession. Let's talk about the data and see exactly what happened. So what we're seeing in this first chart here, this is the monthly rate of the producer price index. Now, PPI, this is basically the CPI, but for companies. This is like the final stage of demand before it actually gets sold to consumers. So this is what companies are paying for the goods and services that are coming their way. They throw a margin on top of this and pass it along to us for the most part. Can be sometimes considered a semi-decent forecaster of what CPI is going to be for the next period as well. So keep that in mind as we go through this here too. Now, according to the Bureau of Labor Statistics, producer prices increased 0.2% in the month of August. And we can see that in this black line right here, that is amalgamated final demand between final demand goods and final demand services. Now, within final demand goods and services did all of the heavy lifting. Now, final demand services were up about 0.4 basis points, or I believe it was 0.3 basis points for the monthly period, whereas final demand goods were not up at all. They were completely unchanged at 0.0%. Now, services happens to make up about 67% of the total producer price index, and that's because consumers, businesses alike tend to spend more money on services than goods. So obviously that's going to be weighed a little bit more heavily. And that's what we're seeing right here. That's why you're seeing that rise come in its place. Now, the rise in services prices was led by a 0.3% spike in final demand services, less trade, transportation, and warehousing. That kind of internal index, or that sub-index itself, was led by what's called finished consumer goods, driving the index up about 0.4%. So that's finished consumer goods that are going from wholesaler to retailer to then be sold and kind of marked up. And so consumer goods, it's a very broad-based term. That kind of stuff is included on the services side because of the way that the PPI reports. We don't need to get that technical here today, but there was really one big thing within that monthly reading that caused it to spike so high, and that was a 4.8% jump in the monthly rate of guest room rentals. Now, guest room rentals, I'm assuming that this basically just means Airbnb, Vrbo, and if you're like shacking up on somebody's couch or something like that. But effectively, guest room rentals spiking 4.8%. It makes this look much more important than it actually is. Like if it's rising by a ton, but it's, a very low percentage point of the PPI, it's still going to have an outsized impact. And so that's somewhat obfuscating the lower inflation that's present in much more services and pretty much everything else involved on the PPI side. Nearly half of all items on the services side declined. They were led by a 2.7% decline in transportation services. And pretty much every sub-index declined at that 2.7% rate as well. So if you're getting cheaper Ubers or cheaper shipping prices, now you know why. But on the annual side of things, if we go ahead and expand our view a little bit more, we can see that this decline from June through August has been very, very welcome by the Federal Reserve, causing, again, a little bit of concerns on the recessionary risk side because declining inflation tends to suggest increasing unemployment. Now, with the BLS, their credibility is kind of coming into question as well. The latest jobs report is a little bit less believed than they typically are because it shows that unemployment somehow declined from 4.3% to 4.2%, despite weak hiring data and what we're seeing going on in continuing jobless claims and initial jobless claims. But nonetheless, that's where the concern for this is coming from. But on the producer side, inflation was looking good overall. Increased 1.7% for the year. That's the lowest since we saw 1.6% back in February of this year. We were slowly climbing from that point up till June and then declined right back down. Now, the PPI can be a little bit more volatile than the CPI at times because a big part of the PPI is what's called trade services. Trade services are effectively just the margin that wholesalers and retailers are adding on top of their products. And that is very variable because it's not necessarily linked to anything tangible that you can go back and point to, but it's kind of just like, what forecasters and what the, pricing analysts are deciding that the company can sell their goods for in order to maximize their profits. Now, leading the services. Okay, so once again, we see that services were leading the way on the annual side as well. Now, coincidentally, final demand goods on the annual side also rose not at all, 0.0%, coming in completely flat for the 12-month period, just like it did in the month of August. Services, on the other hand, were up 2.6% over that period, which really isn't bad at all, but again, pulling the index up about 1.7%. Quite honestly, if services increased by any less, we'd be a little bit concerned that inflation is falling much too low. So, overall, pretty good PPI report, very boring, quite honestly. There's not really anything fun going on here, so we figured we should probably talk about this in connection with the recent updated initial jobless claims data that we also got today. Now, this is tough to see. I wish that they would make the minimum of this 150. I know technically that's like a statistical crime because it seems like you're trying to game the system and try to make things seem like more volatile than they necessarily are, like they go lower than they really do. But nonetheless, it would just make this chart actually legible. And so what you can't really see, but what is borne out in the data is that initial jobless claims increased to about 230,000 for the week ending September 7th. That's up about 2,000 from the prior week's revision of about 228,000. So increasing initial jobless claims, decreasing inflation that's causing concern that the employment situation is actually worse than the most recent labor report let on. And so that led to a change in interest rate expectations compared to what we saw yesterday. So yesterday, we were talking about this huge jump down because a week ago or so, there was a 40% chance of a 50 basis point cut at this upcoming Federal Reserve meeting that's going to be occurring next Wednesday. Now, yesterday, that fell all the way to 14%, and then today, nearly doubled again, up to 27%, at least at the time that I screenshotted this. Let me go ahead and get an updated reading on exactly what that is right now. So the odds of a 50 basis point cut, now it's actually doubled. It's at 28%. So that was the reason that markets were pretty happy on the day here today, because the odds of a 50 basis point cut doubled. They increased quite a bit. They are still very low, so don't necessarily expect that going forward. Like I said, though, psychologically, I think we got a pretty good chance. I'd say it's still around a 50-50 shot because J-Pow is a man of conviction. Usually doesn't do things light. Like, he's not a wait then hurry up kind of guy. He is a wait then hurry up kind of guy, because what he'll do is wait until, he has all the information he thinks he needs and then act very swiftly. We saw this with COVID. We saw this with the rate hiking cycle, and we'll probably see it again with the rate cutting cycle. I certainly hope so, because my portfolio could absolutely use the help. All right, let's go ahead and move on to, okay, that's not supposed to be there, but anyway, let's pretend that didn't happen. Let's go ahead and move on to some of our biggest stock movers of the day. So first and foremost, we have Kroger. Well, like I told you guys, this stock is up 7.14% on a very solid earnings report. The company came in and they beat expectations across the board. They reported EPS of about 93 cents per share against estimates for 91 cents per share. Sales of $33.9 billion were up 1.2% of the year, while analysts were expecting more of a flat year. So analysts were excited to see that, consumers are still going in buying groceries at relatively the same rate that they had been in the past, despite recent concerns that had emerged over consumer spending. Now, at the same time, if we look at, these allegations of price gouging, they kind of just came out of nowhere so that governments can point at anybody besides themselves and blame them for the inflation that consumers are facing. That's really all that we're seeing right here. But if we actually look at the data, which I know is something that is anathema to politicians, it's probably something they've never even heard of, but this is what it actually looks like if we look at Kroger's operating and net margin. Now, you could make an argument that operating margins are slowly climbing a little bit, but look at this. I mean, they're extremely volatile over time. Plus, look at how high this is. This is between the 3 and 4% range for its operating margin, and then net margin tends to be somewhere closer to about 1 to 2%. If you want to go after people's margins and price gouging, grocery stores are not the place to do it. Go to the brands behind these companies. It's not the grocery stores themselves. Go talk to Pepsi. Go talk to, whatever other fucking company you want to get mad at. Campbell's Soup, which is apparently dropping the soup from its name and just becoming Campbell's. Not that that matters at all, but still, if you want to get mad at somebody, get mad at, first and foremost, the government, and then secondly, not grocery stores. These guys, they're doing their damnedest. Look, we got negative profit margins twice in the past 2 years alone. So, this is way overhyped. They are not price gouging nearly to the degree, at least, that, a lot of politicians would have you necessarily believing. But that was one chart that we wanted to show you guys. Once again, Kroger, relatively solid job on their earnings. Now that we are talking about some stocks for a second here, and I don't have any other charts to go over in that time, I'm going to go ahead and put myself back front and center here. Hopefully it doesn't break anybody's screens along the way. But okay, let's go ahead and move on into our next big stock mover of the day. We have Roku up 5.67% on the day. Roku came out and said, "We will rock you." I'm sorry for the cringiest joke of all time. Don't worry, I didn't include that in the written piece there because I want to keep my job ideally for at least a little bit longer. That would be nice. But once again, the stock is up 5.67% on the day, because Wolf Research is getting behind them. Roku, it's been a little bit of a lone wolf in this streaming market, and so it's no surprise to see Wolf Research is coming to their side, forming a bit of a pack over there, if you will. The research firm basically came out and lifted its price target on shares to about $93. They increased sales, earnings, and free cash flow expectations, and also came out and said that the risks are, quote-unquote, more balanced for Roku compared to the broader market, because before yesterday, Roku had fallen by about 21.2% on the year, while the S&P 500 was up about 17% at the same time. So, huge spread right there. Wolf is expecting that spread to narrow. I don't really know what could be driving this. I don't have access to the actual research reports. I just see what's included in PR Newswire for why the stock is up so much there. So, that's all that I saw on this one. My personal theory is that boomers are finally starting to cut the cord. Now, after having conversations with my own parents about this stuff, who, as always, like to remind me, they're not boomers, they're actually Gen X, but, tell that to their wrinkles. I'm sorry, Mom and Dad. I love you guys, but Jesus. Anyway, after I've had many conversations with them trying to convince them to ditch cable. Like, why are you still paying for this absolute nonsense? Thousands of channels when you only watch maybe 5 or 6 of them, and most of the other time is spent on streaming. Well, it turns out that old people will bundle their cable, home phone, and internet bills all in one. Now, this led to my next question. Why do you still have a home phone? Personally, my parents have one, or my dad has one because he runs his own construction company. It's a one-man shop, so he kind of needs it at the house because it's the company's phone. But still, there's really no reason behind that. So for other parents that are doing so, maybe they're starting to realize, like, hey, maybe even this bundle isn't worth it. Not only just having cable isn't worth it anymore, but having this entirety of the bundle isn't working. And especially if you deal with companies like fucking Verizon and AT&T, I can absolutely see why it's not worth it for you anymore, and you would go to something like Roku. Now, at the same time, my grandmother did have some difficulties figuring out how to use Roku, but she has absolutely no problem with their Amazon Fire TV stick. She fucking eats that shit up. So, it could be anything, but that's my personal theory, at least with the information that I saw today. All right, moving on into our stinky rotten moves of the day. We have Moderna stock down about 12.36% on the session. Like I said earlier, this company really thought they did something today. CEO Steffen Bancel was speaking at Goldman Sachs in Europe, and he basically came out. He was planning on getting everybody hyped up. He wanted to be like Jensen Huang and sign some titties on his way out of the conference, I'm sure. Unfortunately, it didn't work out that way whatsoever. He came out there and said, okay, we're going to slash $1.1 billion in total spending between now and 2027. We're also going to launch 10 new FDA-approved products by the end of fiscal year 2027. Sounds great, right? Nope, not at all. Analysts completely fucking hated it because this completely changed up the market's expectations of Moderna going forward. Now, there was a path to profitability within the next about 2 years or so. A lot of analysts were pricing for profits by the end of fiscal 2026, but now they're saying profitability isn't going to emerge until about 2028. Now, given how fast the COVID business has fallen off and Moderna, I don't think they have any other products, and if they do, I sure as hell don't know what they are. They do tend to put out some good, trial data, about once every month or so, and that kind of pops the stock for a little bit. But nonetheless, analysts are not very happy at all with this plan going forward, probably because of the lack of specifics on those 10 new products, and it seems like it was just more hype than anything else. Moving on into our final stock mover of the day, we have Wells Fargo and Company. The bad boy of banking is back at it again. So, if you were going out there and planning on laundering money today, well, your favorite bank to do it through, they just got in some trouble for that. So, very bad day to be a money launderer. America's best bank for fraudulent transactions just left the principal's office with a big new punishment. So, Wells Fargo was at the Office of the Comptroller of the Currency, aka the OCC. This is another bureau or agency under the scope of the U.S. Treasury, along with the Federal Reserve, that regulates the banks. Now, the OCC, on the other hand, they get to regulate, branches of foreign banks that are also in the United States. They do like savings and loans and thrift institutions as well. So it's a bit of a wider scope in that regulatory regard than the Federal Reserve. So they came out here and they hit Bank of America with hefty allegations on their KYC and AML controls. Now, I couldn't find any dollar amount penalties that they're being forced to pay as of right now, but based on other KYC AML charges that have happened in recent years, it's probably not going to be looking too pretty. For those that don't know, KYC AML refers to Know Your Customer / anti-money laundering. Basically, any transaction that occurs at a bank, especially if it's over about $5,000 or $10,000 or so, that's the legal requirement. Banks have different standards internally of themselves, as I unfortunately know from my time of working in one of these. But basically, what they require you to do is to know every single one of your customers and to know what these transactions are for. Now, you don't necessarily have to know, like, okay, Mr. Smith is sending little Johnny, $5,000 so he can buy him a car for his birthday or whatever the fuck. But they just have to know, like, okay, he's taking out, $5,000 and he's not laundering money. That's basically the minimum expectation that you have to have. And apparently Wells Fargo did not do a very good job of this. Now, personally, I don't blame them at all for not doing a very good job of this. When I worked in this sector, we had to do KYC, AML type stuff. You literally have to call strangers and say, hey, what's up? My name's David. I'm at XYZ Bank. And what's your social security number again? It's like, obviously, that's fucking insane to be asking of people. So it's tough information to get a lot of the time. You call out to them and then they say, like, what number should I call back? Which really doesn't make any sense at all, because if I was a scammer, I would just give them the scam number to call back rather than just Googling it. But still, nonetheless, it's a tricky process. There's no perfect solution. So we'll try to cut them some slack right there because I understand the pain of that game. All right, moving on into our final story of the day. The Thought Banana today, we are going to be talking about the housing market, whether this is an outlook or a big lookout symbol. So, housing, we all know that it's been completely fucked in the past couple of years. I know all too well. I told you guys recently about my home buying purchase. Actually, one person did write in and ask questions, and we had a pretty good conversation, I think. Hopefully he's watching or listening to this right now, because I would love to hear from you again. But if anybody else has questions or wants me to talk about this more openly, feel free to let me know. I'm more than willing to do so, but I don't want to waste you guys' time because there's a lot going on in markets, macro, and money that we have to talk about nonetheless. Anyway, we all know that the housing market has been extremely frozen for quite some time. Well, certified smarty pants / my future personal assistant, Torsten Slok, he put out an absolute book of charts. And I don't say that lightly because this thing is crazy. So what we're talking about here is basically a 116-page report that the guys at Apollo put together assessing the housing market. Now, they didn't really have many takeaways from it, but they gave us the information and kind of left it up to your own decision. They say, these are the facts, come to your own conclusions from there, which, I got to respect. And that's why I'm sending out a job offer to Torsten Slok, and I'm sure he'll jump all over it. But a couple of things that we wanted to talk about here. So one of the biggest problems in the housing market right now is just the lack of sales, the lack of building, the lack of any activity that's going on whatsoever. So one of the things that's important is to compare this to recent years and say, is this slowdown really that bad historically, or are we just kind of all overreacting right now? Well, if you take a look at this chart, you can see that it is by far and away the worst housing slowdown during a Fed tightening cycle that the U.S. economy has ever seen. In fact, twice as worse as some of these other ones, so it has been just that bad. Now, this is only going over the year of 2022. Things roughly have improved since then. Very slow moving, very gradual moving market. You think about all of the inputs that change equity prices on a daily basis, and then think about how many more probably impact the housing market. It's probably tens of millions more, because this is easily the most important asset class for most Americans. I think about 2/3 of Americans are home owners, or at least live in a home, and then probably only about 50% or so own equity. So that kind of accounts for the split right there. There's a lot more inputs that are going on here, but we are just going to be talking about some of the most important ones that we think are impacting the housing market's current dynamic right now. So one of the biggest problems that we always identify is supply. Now, the basic problem with the housing market is that there's not enough homes in the United States to feed the demand of the population. That means a couple of different things that we're going to get into a little bit, but first let's talk about exactly why that is. Well, investment in residential construction has been declining as a percentage of GDP, really been in secular decline since right before the GFC, since back in about 2006. We still haven't come close to pre-GFC levels. Now, at the absolute peak after 2020, we got close to a trial that we saw in 1982, but still nowhere close to what it used to be as a percentage of GDP. So the entirety of the economy, we're not allocating nearly as much as we used to total residential investment. Now, most of the time, this gets me fired up at builders, as if I haven't made fun of my dad enough here today. He works in carpentry, builds houses. Go out there and build some fucking more for us, Dad. But nonetheless, I kind of understand where he's coming from, because if we take a look at this next chart, we can see that input costs to residential construction have increased quite a bit in recent years, completely spiking during the period from, before COVID to the period that we're in right now. So it's up quite a bit. So I understand why they're not necessarily going into it. It's more difficult to get to that, ROI position. And that's why you're seeing a high concentration of builders that are focusing exclusively on luxury homes and very expensive homes, things above, $750,000, $1 million, depending on the location. You're seeing that because they need to make some kind of an ROI, in the commodity prices that go in to the raw materials and other goods that matter in the residential construction process have been skyrocketing so much. So once again, got to give them a little bit of slack there. Credit where credit is due. But at the exact same time, when we talk about prices and kind of the frozenness of the market, supply and demand are both of the inputs that we're talking about here. So we understand that supply is the basic problem, but demand is giving builders a tricky picture right now. It's not necessarily something that they want to lean into full-throatedly, because at least on a short-term basis, the demand isn't really there. At least if we look at mortgage purchase applications, we're seeing that it's far lower in 2024 than it has been in prior years. Now, much of this isn't because there's just nobody out there that wants to buy a house. This is because nobody out there can buy a fucking house with mortgage rates through the absolute roof that we haven't seen in 40 years or so. I have no idea how anybody let us buy this house. Nonetheless, I can't imagine going through that process again, or what it's like at this point right now. It's probably a little bit easier, actually, because rates have started to decline a little bit and are going to continue declining going forward. But nonetheless, still, we can understand why it's been very slow right now, because rates are so damn high, especially if you look at these years that they're comparing us to, 19, 20, 21, 22, 23. 2023 is the only one that rates weren't at basically zero for at least one portion of the year. So once again, not a great comparison here. I wish they did this during the other slowdowns like they had in that previous chart, but whatever. We can see the longer-term demand for housing, however, is absolutely still there. If we look, this is basically showing you a distribution of the number of Americans at any given age cohort. And we see giant spikes around the 22 to 24 mark and about the 32 to 36 mark. Both of those prime age groups for home buying. So once again, the long-term secular demand is absolutely there. One of the other interesting things about this chart, not related to housing whatsoever, but if you look in this bottom right-hand corner, it looks like we have more people over the age of 100 than between the age of 98 and 99, which is an interesting factor, but I guess it relates to, what's that? It's not survivorship bias, but it's something like, it's like the Lindy effect, Nassim Taleb would call it. Something that has lasted longer is probably going to have a longer lifetime ahead of it as well, simply because it's been able to survive so long already. So it could be something like that, but I don't necessarily want to get that morbid right now, especially as we get to the end of this conversation. But in addition to this, we're also seeing an increase in household formation. Now, this isn't necessarily what you think it is. This isn't mommy and daddy getting together, falling in love, and then being in love with each other so much that a baby just pops out of nowhere. That's not necessarily what is going on right here. The way that the Census Bureau defines housing formation is just a group of people, and a group is defined as two or more living in the same dwelling, living in the same house together. So this could be you and your buddy. This could be like me and my fucking dog if I registered him as a dependent to get a tax break. Not that I would do that. Don't tell the IRS. But still, household formation can be just about anything. It's more than one person living in a house together. Nonetheless, it's still positive for society overall to see this increasing, and it's most of all positive for housing demand long term, because household formation, households in general, typically like to have a house to live in. All right, but that about does it for us here today, guys. The big takeaway here is that, the housing market is an extremely complicated beast. I highly suggest at least scrolling through that piece that Slock and the guys at Apollo put together. It's 116 pages. It'll take you probably 10, 15 minutes to actually scroll through it and read all of those charts. I would never ask you guys to read some of these reports that we go over a lot of the time, but this is certainly one that could be worthwhile to spend a few minutes looking over. All right, we're going to leave you with a quote of the day from my personal second favorite investor of all time, Mr. Jesse Livermore. He once came out here and said, "The human side of every person is the greatest enemy of the average investor or speculator." Basically saying emotions are what's going to be your problem. This relates to another quote that he has that's the investor's chief problem is oftentimes himself, or it's something to that effect. But again, another nugget of market wisdom from Mr. Jesse Livermore himself, one of the best to ever do it. Really the original speculator, the original day trader himself. All right, that about does it for us here today. I have no idea how long we've been going for, but I have a feeling that it's way too long. So thank you guys for sticking around right now, and we'll see you guys tomorrow. Happy investing, happy trading, and bye now.